Bed Bath & Beyond, ticker BBBY, quickly became one of the biggest retail outlets in the United States. But after 52 years in business, the once leading retailer has filed for bankruptcy protection. Now, the big question on everyone's mind is, will it survive bankruptcy? Filing for bankruptcy protection isn't quite the same as filing for bankruptcy. Seeking protection gives a company the chance to restructure its debts and operations while still allowing the business to maintain its livelihood. A full-on bankruptcy is not as forgiving. The alternative often means the company has to liquidate or sell off assets to pay back its creditors, which can lead to them having to close their doors for good. By filing for protection, Bed Bath & Beyond is basically trying to buy some time, reorganize their financial house, and figure out a game plan to bounce back without having to face the grim reality of complete bankruptcy. So what do you think? Does Bed Bath & Beyond have a chance to make a comeback? Or are they going to join the corporate cemetery? Tell us in the comments below and stick around to find out what we believe will happen. And while you're at it, don't forget to hit the like button and subscribe for the best updates and insights about the stock market. It's not uncommon for companies of all sizes to be pushed to the brink of bankruptcy and still claw their way back into a healthy financial position. After a government bailout and restructuring process, General Motors emerged from bankruptcy in 2009 as a new company. After restructuring and selling some assets, Six Flags also emerged from bankruptcy in 2010 following a bankruptcy filing in 2009 due to heavy debt. In 2011, American Airlines filed for bankruptcy, citing high fuel prices and labor costs. But 2013 marked the end of American Airlines bankruptcy after restructuring and merging with US Airways. If you're sensing a pattern, it's because there is one. The examples I just mentioned all avoid the grim reality of going defunct and proved that it's possible for companies to survive and thrive later on. But dodging corporate death was not a walk in the park. Typically, it requires significant restructuring, cost-cutting measures, and sometimes external assistance. Background story. The company was founded in 1971 by Warren Eisenberg and Leonard Feinstein at discount store chain Arlen's. Warren and Leonard used their stint at the company to learn the ins and outs of a store chain. As the company encountered financial difficulties, both of them had already learned a great deal. The knowledge they had picked up made them realize first that the market was geared towards specialty stores, and this is when they decided to leave and form their own company. After forming Bed Bath & Beyond, the brand quickly rose to popularity and opened 17 stores across the country. But their meteoric rise didn't end there. They quickly usurped their competitors like Linens and Things, Pacific Linen, and Luxury Linens. So in order to properly represent their newfound dominance, they not only integrated computer-based inventory management systems in 1993 and opened 7 new superstores in New Jersey, California, Virginia, Illinois, Maryland, and Florida. A couple of years later, BB&B was still riding a wave and they were doing one big thing after the other. Shortly after going public and making its IPO on the Nasdaq Stock Exchange, the company started trading under the ticker symbol BBBY. The first 7 years after going public were blissful for the BBB company as they first reached $1 billion in annual sales in 1999. That's an impressive feat until you fast forward 2 decades and realize they dwarfed that amount in revenue. In 2021, Bed Bath & Beyond registered net sales of approximately $7.87 billion US. But you know what's interesting? They actually took a hit, considering their net sales were around $9 billion the year before. This is a company that was once lauded for its brilliant strategy, something we like to call the subtle upsell, a strategy that gets customers to buy more things than they intended at a physical store. Because of this, it wasn't uncommon to hear BB&B customers say things like, "I came in here for a shower curtain, but I just walked out dropping $300. And if we're being honest, we all know what that feels like. But now, Bed Bath & Beyond is a shadow of themselves and fighting to stay in business. The fall. The most obvious cause for BBBY's crumble is how the management failed to capitalize on the benefits of the internet. One would expect that a business like BBB would flourish during the rise of e-commerce, but the opposite happened. At times when shopping was evolving, BBB was still under former CEO Stephen Tamares' control. Stephen's views on the retail business were referred to as old school, traditional, and dated by many analysts. And they weren't wrong. When the CEO of a multinational brand believes a retail business in the 21st century can base its sales model around stack it high and let it fly strategy, anyone at all could tell how it wasn't always going to be the best move. Stephen overestimated Americans and their willingness to keep going to physical stores even when there was a much easier method of shopping quickly on the rise. If I were to ask a group of people what year a retail giant like BBB finally decided to tap into the internet money wave, the answer would have been different from reality. Bed Bath & Beyond finally made and introduced a website after changing their CEO to Mark Triton in 2019, just 4 years ago. But beyond the stagnancy and unwillingness to leave the archaic brick-and-mortar model, Bed Bath & Beyond made even more mistakes. Another one was the failed attempt to replicate their competitor's success. You see, Bed Bath & Beyond has always been in close competition with Target, mostly due to their overlapping product categories, particularly home goods. While Bed Bath & Beyond may appeal to customers seeking a specialized focus on home goods and unique products, Target attracts those who prefer a one-stop shop experience with a wider range of products at competitive prices. These similarities and Target's success led the management of BB&B down the wrong path. They tried selling private label products like Target did. Under the new CEO's management, Bed Bath & Beyond store managers began stocking the shelves with products from at least 10 company-owned brands. But due to many interesting factors, their project failed. Some of the factors included a poor marketing strategy, subpar products, and a discouraging demand level from customers. But we believe that wasn't the worst mistake Bed Bath & Beyond made. The company made a grave financial misstep, and it's safe to say that's what broke the camel's back. Under Mark's management, the company started to move in a different direction. After taking charge, Mark Triton wanted to make stores feel different to customers. So he revamped the store's appearance while reducing the volume of merchandise displayed. Then in 2021, the company decided to spend $625 million on share buybacks, later proving to be an expensive decision. The stock repurchase sent ripples throughout Bed Bath & Beyond's supplier network. Even the supplying arm that was responsible for shipping goods to stores were taken by surprise and left worried by the company's decision. They feared the company's repurchase would leave them low on funds to pay suppliers, leading many to limit their dealings with Bed Bath & Beyond. Consequently, there were fewer products available, leaving customers dissatisfied. The situation unfolded at an inopportune moment just before the coronavirus pandemic. Between 2018 and 2019, consumers increasingly turned to companies like Amazon, Target, Walmart, and Wayfair. The pandemic further accelerated this trend as people sought to enhance their home office spaces. These three mistakes, I think, are responsible for Bed Bath & Beyond's downfall. We can now try to answer the million-dollar question: do they have what it takes to survive bankruptcy? I think they've tried their best so far. One of the tricks they pulled out of their sleeve was raising $1 billion in preferred stocks and closing down all operations in Canada. To be fair, that move was more of a Hail Mary than anything else. But they made other small reshuffling decisions also. Bed Bath & Beyond was able to raise $225 million through an equity offering in February 2023. While these moves sound good on paper, the efforts to restructure and save the company came a little too late. The sale of stocks and fundraising seem like they're delaying the inevitable, and Bed Bath & Beyond may go extinct very soon. In conclusion, the company was a market leader that didn't do enough from a distribution standpoint. They remained in their dated ways for too long, and all plans to rapidly modernize failed. As for the company's stock, it's safe to say that it's not worth investing in. You may not know this already, but in many cases, the stock of such a bankrupt company may be worth very little or even nothing at all, which makes sense when you realize BBBY stock was trading at 11 cents at the time we recorded this video. In conclusion, if there's any positive in the case of Bed Bath & Beyond, it's the lessons you can learn from their mistakes and not the stock. If you've enjoyed our talk today, let us know in the comments. We want to hear your thoughts and predictions. Thanks guys, and catch you later.